Welcome to the Crypto Compliance Podcast by Gatenox.
Pawel Kuskowski, welcome in Crypto Compliance, where compliance experts and practitioners are talking about current market events and general compliance aspects. Today I'm here with Carol Van Cleef, our regulatory and compliance expert from the US, and Amber Scott from the Outlier Compliance Group, the leading crypto compliance advisory firm from Canada. Welcome, everyone.
Well, thank you, Pawel.
So, first topic which I wanted to bring to our conversation is, most recently publication of SEC and sanctions breach by Kraken. It looks like, it's becoming very interesting and very topical, especially from the compliance perspective. It's less interesting from the overall market perspective because the fine is ridiculously low. But Carol, you published a tweet which actually got really interesting attention from Jesse Pawel, who is former CEO and founder of Kraken, and who actually said, and let me actually read, what's actually in the tweet, because I think it's very interesting and topical. To be clear, the payment is for settlement, not a fine, of a self-disclosed potential issue. The geo IP, this is complicated and it's not about KYC. People can register in one place and travel to another. Geo IP database can become stale and aren't perfect. People use proxies. I think, this is jargon which I'm not sure if this is helping anyone, especially Kraken and Jesse, because how I read this, there's a lot of more questions actually created than answers or defense. But let's first break this down. First, is there any way you can create defense from self-disclosing sanction breach or sanction, let's say, deficiencies? Amber, you want to start on this?
So I think there's very different laws depending on which sanctions you've breached. And OFAC is always particularly fascinating to me because it's a zero liability. And in most cases in compliance, we have this idea that I think we all understand between ourselves that compliance is never perfect. And the intent isn't to have penalties in cases where people made their best efforts and they did all of the things that they were supposed to do to meet their regulatory obligations and didn't make it. And in the case of zero liabilities, it matters in a sense that you tried, but there can still be a penalty there in a pretty significant way. And I think, Carol, maybe you can give a better descriptor to that. But that's something that I often preface for our clients in Canada that have OFAC obligations because of their U.S. touch points.
Thank you. And OFAC sanctions compliance and the OFAC enforcement regime continues, I think, to be a significant matter of confusion for many people. And I think that Amber's comment about zero liability is well taken. We don't like to think of it as fully strict liability, which means if you do the deed, and the deed's prohibited by law, you're guilty. But that's basically the way OFAC approaches the world. They say you can't do business with Iranians, for example. Interestingly enough, the U.S. played Iran yesterday in a very public soccer match. I kept scratching my head and wondering what kind of OFAC waivers had to be put into place for that to happen. But bottom line is OFAC says thou shalt not do something. The expectation is thou isn't doing something. And if thou does do something, then OFAC has full reign to impose penalties. What it has done over the years is put into place a regulatory framework by which it will allow the violating party to bring forward mitigants, things that will lessen the severity of the punishment for the violation. So, for example, if you self-disclose to OFAC that you've been involved with a violation, right there you cut a fine in half. which is a pretty significant issue. If you go forward and raise your hand and say, hey, I did a transaction with someone I shouldn't have done a transaction, and assuming that hasn't been found in any other kind of legal proceeding, that will immediately cut your fine in half. And then another major mitigating factor are whether you have a compliance program that contains many of the elements that OFAC is looking for that would help you reduce the chances of violation. And one of the key elements of that is using some sort of a interdiction, as we call it, interdiction solution, which allows for you to review transactions, for example, before they happen, that would allow you to stop them. Unfortunately, in the OFAC world, if you allow that transaction to go through, you've gotten yourself into the penalty box. And that's why having an interdiction software is important. If you can show you're making a best effort to look at those transactions and take steps before the transaction happens, that can help mitigate your issues. One of the problems in the crypto world, as we know, is it's very difficult, at least at this point in time, to be able to interdict before the transaction happens. If you're allowing for essentially instant settlement of the transaction, which crypto makes possible. There are some interesting solutions that are starting to emerge in the marketplace that may help us get over that, but we're still in sort of the early days of putting those pieces in place.
Yeah, I think you're right. And it's interesting because I think it's much bigger issue than just simply, talking about Kraken. If you think about broader crypto market, DeFi space, NFT space, I wonder what's going to be the answer. And, speaking with many of those, you simply understand that it's not about them not understanding really what is happening. It's simply the choice they make to ignore it, right? And that's something that especially for sanctions, I think that's something that it's not acceptable in any way.
It's an interesting question because some of it is ideology, some of it's ethos, and some of it's just plain religion. Or
it's just being practical and not like limiting your, let's say, customer base.
Well, and the idea is, crypto, we're supposed to be anonymous. That's the beauty of crypto, is that we should have that level of anonymity. And that's still very much the view in a lot of the NFT space, is that the idea is I can go to a marketplace and I can buy something and I shouldn't have to provide my information, any information about me. Gaming is a huge area where the gamers come to play. And the idea of introducing any friction in that initial engagement is, I won't say an anathema to many companies, but it's a challenge. They don't want that friction to come in.
An IP location, which Jesse mentioned as well. Geolocation and, recognizing where someone is logging into the system, right? Or where transaction is actually happening, because, many of the transaction you can actually, in crypto world, crypto transaction, you can link to IP addresses. And interestingly, there is there's leakage of information from MetaMask, which I think, it's another aspect where it turns out that they are collecting a lot of information, which surprisingly also, it wasn't known to the market. It was known to the market for many, many years, I believe. This is why, they were bought actually, right? Because they're collecting a lot of interesting information. So for this purpose, tell me, what's your view on the geolocation aspect?
I think it's complicated, and it also depends on how it's hooking into your systems. This is an issue even in traditional finance, where you have the idea that I've KYC'd, I've provided you my Canadian passport, I've provided you proof of my address in the city that I live in, but that doesn't mean that I'm there eternally. I may have moved, I may actually be located somewhere else, and I don't want to say that compliance people are the worst, but I'm sure that anyone on this call can tell you how to very easily get proof of address for a place where you don't actually reside. It's not rocket science. And so there are all of these other ways to start to look at where is a person really, but those systems aren't necessarily plugged into your compliance systems. A lot of times when there's been geolocation and IP-based geolocation, that's connected to fraud systems in terms of, is there an unnecessary, is there an intrusion? Is there someone trying to access the account that shouldn't be accessing the account? But it's not necessarily connected in the right ways to your anti-money laundering systems, to your sanctions systems to detect that type of information. There is sometimes an outright blocking of sanctioned countries. And so you might, if you have some type of connection coming in from Iran or North Korea, that might be instantly blocked where the site isn't even accessible. But beyond that, those things aren't necessarily connected into your core compliance systems in a sophisticated way. And there's also the potential to manipulate that type of data. So if you're using a proxy, if you're using something to mask your IP address or make it look like you're in a different geolocation, those can be fairly sophisticated. Some of them are simple and they can be detected. And in those cases, some systems can actually serve up a request that says, hey, it looks like you're using this type of system. Can you please access our site without it? But some of them are much, much more sophisticated and much more difficult to detect. So I think that there is complexity there. Really sophisticated systems will look at other factors. So for instance, if I say that I'm in Canada, I say that I'm in the Eastern time zone, there's pretty much a block in which you would expect me to be accessing a site. So if I'm always accessing it at 4 a.m., that would raise questions about what time zone I'm really in, or how much coffee I've had that day, but probably about what time zone I'm actually in. So there are other measures that can be used with compliance systems to start to get to where a person is actually located.
I guess I've got red flags all over my files because of the odd hours that I keep. But I to Amber's point, this really came home very personally to me several years ago. 5 or 6 years ago, my daughter became very interested in a soap opera in another country. And in order to access it on Netflix, she had to have a Netflix account in that country. And so some of her coworkers taught her about VPNs and how to set up a VPN and to create the image that she worked in that, or she was in that country. And that then she got her Netflix account, and the rest is history. But that was several years ago, and so I realized, what we were in for in this space generally, in terms of trying to understand where somebody really was at any given time, because she certainly wasn't in the country that she was supposedly in to access the Netflix show. Having said that, I spoke before a internet gambling conference a number of years ago, probably 15 plus years ago. And I was surprised, and if people remember back in those days, and still where you're located is very important because gambling laws are, very strict and are enforced. And I was surprised even then the amount of technology that had been developed in the gaming industry to be able to track location. And I have not seen a lot of that, at least over a 10-year plus period of time, a lot of that technology move into the world that we live in with respect to OFAC. And that's always puzzled me because it seems like the tools are there. Now, I think a big issue is money. Is the cost that each time you run a check like this, it is going to cost money. And in the gaming industry, it's worth their spending that time and that money to make sure they've got it right. In the world that we live in, I don't think that cost-benefit analysis has necessarily been made.
You see, 2021 revenue of Kraken was 1.37 billion USD. Which I think that's enough budget to properly close this type of loops. But at the same time, as I wrote in my LinkedIn post, if you think from the management's perspective, the message which we are getting right now is the sanctions can cause you 0.0002% of impact for your revenue. It's not worth actually management attention. So I think this is the wrong message which we are getting to the market with this, and I think we're gonna see some fallouts from this side. Moving on, FTX. There's a lot of information coming up. Really interesting information, and one of the I think most intriguing information. I don't know if this is true, but Amazon won movie rights to film to create series right on FTX. So that's gonna be really interesting. That's gonna be really interesting movie, I guess.
I'm not sure how you write the script yet, unless it's everything leading up to the moment that the bankruptcy filing is made. Because I think we've got a lot more scenes of this movie or play to still occur.
Yeah. And the banking sector and the impact from fallout from FTX. What's your view? We have the small bank which was invested by FTX. What we can make out of this? Doesn't make any sense in terms of business or, as from compliance perspective, was it needed?
Well, I think my concern, having been a banking regulatory lawyer for many years and having worked on multiple rounds of bank failures, is making sure that people have the right information and they understand the facts correctly. And one of the things that concerns me is I think we've seen some, I won't say irresponsible, but maybe not entirely accurate reporting happening in the press. I know that the first story I read in the New York Times, I believe it's New York Times, could have been the Wall Street Journal. But what I read was that FTX had bought a bank. And that sent off warning signals to me immediately as well. Wait a second, if they bought a bank, we would have known about it by now, because in the US, we do have a process if you buy control of a bank. Actually, if you buy more than 10% of a bank, there's a prior approval that is required at the federal level and most likely at the state level if you're a state chartered bank. And if that is going to be sought, that information would become public pretty darn quickly. So we would have known it months and months and months ago when the transaction apparently happened. So that was the first bell, first warning signal that went off in my mind. Interestingly enough, there was a Twitter space over this past weekend where the actual owner of or controlling party of that bank, his son, appeared in the Twitter space and spent probably an hour or so answering a variety of questions. I think, there's one thing of looking at banks being involved. In this case, the very quickly we get to additional levels of complexity in the story, in that the owner of this bank is a gentleman who also owns a bank in the Bahamas. And that bank is well known for having serviced both Bitfinex and Tether. So some very close ties there, which then again, being, knowing what the process is like to get approval in the US, he apparently bought this US bank, Farmington Bank, in late 2020. So he did have to go through an approval process. So that means that US regulators probably did know about his ownership of this bank in the Bahamas, and they probably did know if they just did probably fairly simple Google searches, they probably knew about the tie to Tether. So just interesting issues that are out there. And then one more point, which will maybe lost on most of our listening audience, but it's an incredibly interesting point to me, is that it turns out that this bank, under new management last year, became a member of the Federal Reserve System. Not to get into all the complexities of regulation in the United States, but you do have an opportunity to choose your federal regulator. Typically, banks that are chartered under state law, they have to have a federal regulator. So you either choose the Fed, become a Fed member, a member of the Federal Reserve System, or you stay with the FDIC because you're federally insured. And in this case, most banks choose to stay with the FDIC. Very, very few decide to go in this day and age with the Fed, because the Fed is typically regarded as being a more rigorous regulator. So this said, it could be the FDIC said, hey, if this bank wants to be involved in the crypto arena, we're not going to have anything to do with it. You've got to go to the Fed. And so the Fed was the regulator of last resort. But it does raise a lot of questions for me.
Oh, I was just going to say, I think it will be interesting to see how that falls out. And from the Canadian regulatory perspective, we did get some edicts from our federal bank regulator. Fascinatingly, they weren't actually in response to FTX. So there was a number of pieces that came out in August, although there was a reminder subsequent to FTX that was sent out to remind institutions. And part of that was how any virtual assets on the balance sheet would be treated. And they divided it into type 1 and type 2. And type 1 was a digital representation of an actual asset that you can prove is in a bank, whereas type 2 is kind of everything else. And the kind of TLDR on that was that if it's a type 2 asset, so if it's just about every virtual asset that exists today, the idea was that if you were lending, that wouldn't actually, if you were lending and that was held as collateral, it would count as an uncollateralized loan on the books. And so essentially you had to value it as if it didn't have any value. And so it's a relatively conservative approach to virtual assets. And that's there right now. And it's the temporary measure that's in place in terms of how federal financial institutions deal with virtual assets. I was also very critical initially, even for virtual asset service providers. So all of our exchanges in Canada that are custodial, we had regulation that came into place, or an interpretation rather of existing regulation in 2021 that said that these companies are considered securities dealers and required to comply with securities law, which includes a number of prudential measures about how you custody your assets. And I was very critical about that being a square peg in a round hole. And I still think that to some extent. But we've also seen a tremendous professionalization in the industry. We've seen a fair bit of consolidation in the Canadian market. And we have weathered the FTX issues relatively well. And I'm going to knock on wood as I say that, because as Carol very astutely said, much of the story has yet to be written. But a lot of the Canadian companies had no exposure or minimal exposure, which I think is probably a feather in the cap of our regulators at this point.
Well, and Amber, thank you for noting the regulatory guidance, because the same thing happened in the U.S. I think there was a little bit of coordination maybe happening across the border there, because it was August as well, when our banking regulators came out and basically said, you have to talk to your examiner, which the examiners are sort of the lifeline into the regulatory agency, tell them what you're doing, and then essentially wait for their approval that you can go ahead and do it, which is, in regulatory speak, is pretty much the kibosh, putting the kibosh on the efforts of the entity to do something. But I think you highlighted 2 points. One is distinguishing between the bank offering the companies that are in the crypto space services. Banking services. So that's, we've seen Silvergate in the news a great deal. That's the role that Silvergate plays in part. And this is the role that it was clear based on the Sun's discussion in Twitter space the other day that this bank, Farmington Bank, is planning on playing vis-a-vis the crypto space, is to provide the crypto firms essentially access into the banking system to be able to accept fiat deposits or to be able to pay out in fiat and handle other kinds of traditional banking type services. And that's different from the lending activity. And what I observed is the crypto space, because they are coming off of the Celsius, Voyager, Celsius, now BlockFi, have been focused on the lending exposure of the bank and what that means for the viability of the bank. And it's really two very different sets of issues that we're talking about here. And that's where I go back to making sure that these stories, the conversations in the press and so on are correct. Because if you don't understand that difference, you go off in different directions. I do think, based on, I'm unfortunately a veteran of too many of these debanking or de-risking pogroms that we've gone through in the U.S. Over the years, really going back to the first wide-scale one right after 9/11. But we've seen it every few years, and I'm fearful that if not managed correctly, we could see that happening again with respect to the crypto space. So I'm glad to hear that things are going well in Canada right now.
Yeah, I think, overall, the regulators in the US are responding very professionally to the entire, scandal, what is not the case in the UK and in Europe. We see many banks simply saying, we don't want to bank the crypto businesses. We don't want you to send money to crypto businesses. That's something that we start to hear in Europe, which is very, interesting. I think that's the opportunity given for them, and they just simply use it like as a competitive part. Another aspect for FTX is, if we say that if you read the news, there's a little bit of saying that it was 30-year-old cult, and teenage cult, and people simply are young and they're doing stupid things and all this stuff. But it looks like very sophisticated purchase, to buy a bank. That's something that it's not something that you usually think of as a 30-year-old, right? That's something which is not matching the odds here.
So this is a funny, I think when people have banking issues, and I won't argue that banking in Canada for the crypto asset industry is perfect. In fact, I would say it's probably the biggest barrier to entry, full stop. Not just for crypto assets, but for MSBs, so money services businesses, remittance, foreign exchange. For those type of businesses generally, maintaining banking is probably the biggest barrier to entry. And when you're dealing with that, especially in comparison to the normal process of getting a bank account where I walk in, I have my paperwork, I'm in and out in under an hour, it's daunting and it ends up being a lot. And I don't think it's unusual for business owners, especially when they have a really high degree of revenue, which is to say that I've dealt with this question in at least the double, probably triple digits over the last 10 years, is that question of, and what would it take to just start a bank or to just buy a bank? And the answer to that is a high number in the certainly double digits, probably triple digits, millions of dollars of very patient money, and probably grown-ups running your company. And I say that with love, but our regulators don't approve folks with no financial experience to be running a bank. And this is one of the few success stories I know in that area where companies have evolved to become a bank or have acquired a bank and moved it into their operations. One of the things that happens is that suddenly the people that are members of your board, that are members of your senior management, are no longer approved in that role. And so you have people that you've promised directorships that maybe have been early investors that are now asked to step down from that role because they don't have the right experience to be a director for a federally regulated financial institution. They don't have the right experience to be the president, to be the CFO, whatever, of a federally regulated financial institution. There are very strict criteria that are set out, and those have to be approved by regulators. And I think this is a difference in terms of the evolution of those types of businesses. The banking sector has been around for a long time. There's a lot more prudential regulation and regulation that is set out to make sure that the right people are in those roles. And we just don't have that in crypto assets. I think it's fair to debate the degree to which we should, But this is one of those places where I think that although I was really critical of what the Canadian securities regulators were doing early on, it did force a professionalization, at least of the businesses that were custodying investor assets. And there's value in that.
If I might jump in there, because Amber made a number of very good points, and I've been through this repetitively through different types of emerging and alternative payment systems. As they reach a certain point, they get frustrated because they can't get their bank account, and so the first thing they say is, "Well, let's buy a bank." And that conversation, it's sort of having that talk with your kids, that you have to sit them down and say, look, it's going to cost X to do this. That it looks like on paper under the U.S. banking statutes, you could, it says $2 million minimum capitalization to set up a bank. But in reality, the regulator looks for at least $40 million of capital before you can get past that finish line, much less handling all the other details that Amber went through very nicely. The critical point that I think why this round is different than previous rounds is these companies, for the first time, really have the resources to go do it. And that's been the game changer, so that when you have this kind of a conversation, it's a more meaningful conversation, because yes, they do have 40 million, they have 100 million, they have that excess capital that they can spend on the bank charter. So this is, I'm not surprised that there was a discussion like this. I'm not surprised that things that things evolved as they did. I do think there is a point that was brought out in the questioning on Sunday in this Twitter space, is that apparently the person who led the conversations with the bank is the same person, the former general counsel of FTX, who has been implicated in some activities a number of years ago that have raised a lot of questions about his personal credibility. And I think that's another overlay to everything else that's going on right now.
Yeah. Then there's a lot of discussion around also, proof of reserve, and that's something that it's, opening completely new, let's say, area. And I've been discussing with a number of people who apparently, they couldn't attend this podcast because they simply couldn't disclose information in relation to the clients, right? But there's so proof of reserve in principle is disclosing addresses, cryptocurrency addresses, where the assets are held in hot and cold wallets for cryptocurrency exchanges. And I think one of the biggest one which was disclosed was Binance, right? And there's immediately discussion of what does it mean for security of this particular exchange, and what does it mean for security of the entire ecosystem. And so, what's your view on this proof of reserve? How actually disclosing this would improve or actually not impact?
I think there's value in that, but a lot of proof of reserves, at least the iterations of proof of reserves that I've seen to date, aren't particularly sophisticated, which is to say that you have something and it's pointing at a wallet, and we're saying this is what we're including in our proof. And unfortunately, you kind of need something that goes beyond that to say that, do I actually have ownership of this wallet? Is this actually part of my assets? Is this customer assets? Is this my assets? What is this type of thing? And so you really need something that combines your traditional accounting type of audit, where you have a second, probably third pair of eyes on things, in order to validate that this really is what you're telling me it is, that I'm not just setting a pointer that goes to a wallet that I know has a lot of Bitcoin, but it's not my Bitcoin. I don't really have control of those keys. So you need a level beyond that to really look at what these things are and do they tee up to what I'm telling you they are, which is not to say that just a strictly cryptographic proof of reserves doesn't have any value. I think that there is value there, and there's fairly interesting things that are being done with that in the context of certain companies. So one of the companies that I deal with that's custodial actually has and on an individual level. So if you're logged into your account, you can hit a button and see their proof of reserves related to the crypto assets that they are storing for you, which I think is a pretty fantastic piece as far as customer confidence goes. But I do think in terms of being useful from a broader compliance perspective, from a financial audit perspective, we're not quite where we need to be yet.
And one of the big issues that I have with the concept is I think Amber dealt with those issues of here's the wallet. How do you know I have control of the wallet? I'm looking on the backside is that what is there to prevent me from what kind of rules or requirements are in place that say I can't go drain that wallet at any point. So it's great to see, I could see right now I have the proof of reserves for an entity are X, but the next minute that's X minus X or some other portion that's been drained. And what kinds of protections around keeping those reserves being drained? That I think is the next step here. So it's one thing to have the information, but two is that what does that information really mean on the backside? Is it really going to protect me? The other point, and I know that there's been in the press at least some pushback from a couple of entities on the proof of reserves, or shall we say that these entities have been criticized for not providing proof of reserves. And these are public entities, the entities that have securities that are traded in public exchanges. And under U.S. laws in particular, providing that moment-by-moment update of what your balance sheet looks like is actually a public event and means that there's public disclosure. So you would have almost every minute or whatever the time frame you're updating your proof of reserves for public disclosure, you'd have a filing requirement with the Securities Exchange Commission. So it's an interesting dynamic here, and one of those issues that, if this is a direction we're headed in, is going to have to be thought through more carefully.
That's really interesting. So Coinbase, for example, in this situation would be effectively blocked from publishing this because this would be ongoing, impacting their performance, liquidity. Yeah, really interesting. But let's come back to the proof of reserve aspect, so because this is, I think, topic which is not widely understood in the compliance world, right? And so this is just crypto, right? We're still talking about the assets which are, let's say, in fiat, right? In traditional currencies, and then assets and liabilities, whichever you actually have. So just to compare this to traditional finance, it looks like we have this dealt with via audit, right? That's something which is the biggest, let's say, part of making sure that the bank is run the right way. And today I spoke with one of my friends who is auditor for many years, and he said, like, in banking sector you have actually 80% of staff looking what 20% is doing. Right, which is compliance, risk management, all those different people in banking, and then you have the crypto sector where you have 5% watching 95%, right? And that's something which I think needs to change, and so we need to definitely grow compliance departments in crypto world, right?
I think that's true. And I feel like I also need to make a distinction between what I think audit, particularly so your external audit function can do and can't actually do. You're talking about a random sample testing. You're hoping that you catch things that are relevant. But unless something is really blatant, audit isn't a detailed review of everything that's happening within an organization at a particular time. And so I think that we have an expectation that financial audits will definitely catch frauds. And that's not necessarily true. And even as someone who performs AML compliance effectiveness reviews, we'll look at a program, we'll look at sample testing, but there are certainly ways that organizations can hide what's happening within the organization and can present a very positive face when there's something underneath that is problematic. I think in both of those situations, in terms of compliance audits and in terms of financial audits. And so what you point out in terms of that level of internal control, are there lines of defense within the organization? Are there more than one set of eyes on something that's happening? Are there incentives to get it right within the organization? That's incredibly important. And that's something that we've seen go off the rails in various ways in the traditional financial sector. So I don't think that's limited to crypto. But we have seen things like the misalignment of incentives, even in incredibly regulated sectors. For instance, where within a bank in Canada, we had people that were they were incented to sign up new customers. And so there was this creation of fake accounts because there was a financial incentive to sign up new customers. And we had goals to sign up X number of new customers. And so, let's create these accounts with no balances. And then we meet our goals and incentives and everything looks good, although it's a house of cards.
It sounds so innocent in comparison with what happened with FTX, right? This is...
It does, but I think we always have to look at where are the incentives? What's the alignment of those incentives? Not just what are we required
conflict of interest.
To do? But what are we incented to do, and how do we balance that appropriately?
But that is often much. The talk is easier than the walk on this. Especially in small organizations where the incentive to grow as rapidly as possible exists in order to be able to attract the next round of capital that will allow for the entity to grow further. So there's a constant tension, and you're spot on there, but it is just, it's always a gut-wrenching process within an organization.
I don't know about you, but I think about the incentive to grow as rapidly as possible as being kind of a systemic dysfunction.
Well, we'll turn that to Pawel, the serial entrepreneur.
Yeah, no, I mean, there's definitely, this type of approach, and, partially, I think that's something that we can blame also investors in this sector, right? Some things came up, and I still need to do proper research on this. But I think in the industry we saw a lot of investors buying tokens early, then dumping them on retail. I mean, there's something. I mean, from the conflict of interest, ethical point of view, that's something ridiculous, I think. Is there anything you think outside this which would be breach of regulations or law, like from that perspective? Investors who are simply getting, I don't know, 90% of discount, and then retail is buying off them. They are making in 1 year 10x, and they do this over and over again.
It's interesting you bring that up. We actually in the U.S. have congressional hearings today on FTX, and all of the regulators are being brought up to justify their actions, which, as Amber said earlier, back in August, the banking regulators took big steps to be able to walk up to the Hill today and say, hey, we've done our part. It's really up to you. And they've really set themselves up very nicely for this round by saying, we've done what we need to do. And we've told you we need legislation, and you, Congress, haven't acted. So it's really on you. At the same time, there's an interesting dynamic at play. And I'm going to get to your question in a minute. But it's a little bit of a way around. But there's a dynamic at play on Capitol Hill right now about the money that FTX, SBF, and others on his team have contributed to campaigns of members of Congress, the president, and so on. And originally it came out that all the money had gone to Biden. But as of yesterday or this morning, SBF said basically they've given equally to both sides. And equally is what numbers I've seen, $500 million or more to each side. Now, that's a long way into answering your question about the role of the investors. One of the issues that's being looked at here is, where were the investors? The investors were putting in money. The last round was what, $900 million or whatever it was. Why wasn't someone doing due diligence? Why didn't they understand, who owned what, with all these intersections, these conflicts of interest that have, put this whole venture in much of the condition that's in today. And what is coming up in those conversations is exactly what you said, is that the investors were going in early, they were giving money, getting these tokens and flipping those tokens as soon as they could for a very sizable return. And so I think I'm assuming that the SEC probably is looking at this issue as to whether there is any kind of a securities law violation. Now that it's been brought fully, the mask has been dropped, and probably the gloves are off, and the SEC is going to have a greater amount of discretion to pursue issues that are identified problems in this area.
It's maybe not as sexy, but from the Canadian perspective, when dealers in virtual assets that are custodial are registering with the Ontario Securities Commission, for instance, they're applying, and it's on a case-by-case basis, but it's strangely the same for everyone, caps on what retail investors can invest in. And so there's only a certain dollar value if you're a retail investor, so you're not an accredited investor, that you can buy in anything that is not Bitcoin or Ethereum. There is a requirement that all of the tokens that are offered on these platforms be assessed. And from FinTrax, or anti-money laundering regulator, there is an expectation that they're being assessed from an AML perspective as well, that there's someone looking at the soundness of these things. So who is the team? What's behind it? What's its function? All of these types of things before any of these assets are listed on the platforms. And I think that as an industry, that's something that we'll move towards. There's an expectation that these companies will have a type of fiduciary responsibility where they're looking at the assets that are being listed there and not just listing things for trading willy-nilly.
As a footnote to that, that's the approach more or less that Hester Peirce, the SEC commissioner who's been out front on these issues for years, has been suggesting. But for a long time, it was dismissed by the more hardcore regulatory types because it really wasn't enough. It was too light. It was too easy on these deals. And I think what I'm hearing from you is, if we had taken at least that step, we would have a baseline that would provide some level of protection that doesn't really exist now.
I don't think it's perfect, but I think it's better than bad. And it actually goes a long way in preventing some of these weird pump and dump schemes, where if the only place that you can buy things, so you think about penny stocks and how we still see pump and dump schemes in penny stocks, but the only place you can buy them is in these over-the-counter markets. So I can't go through my normal brokerage and buy them. I have to take these other steps if that's something that I'm really interested in. And so for most of retail, that's not how they're going to get to that access point. So I think it actually goes a long way. Is it 100% of the way there? No, but it's better than 0%.
Yeah, but I think, you can still bypass it using some foreign exchange, right? Some in Bahamas, for example, right? And you can bypass the requirements. And it's, it seems like, everything is going in the direction that this should be treated like gambling, because this is very similar things we can hear from the regulators. All right. Listen, I wanted to touch on Binance still, but I think we are running out of time this time. So listen, thank you very much, Amber, Carol. This was excellent. Thank you very much for this.